All right, can y'all hear me now?
Yeah, good morning.
Okay, good morning. Sorry, we were just finishing up class. And okay, first, well, I'll wait until, oh, it's 9:57. I got time. I was eating an English muffin, so don't watch me eat. I was starving, and my husband brought me an English muffin with peanut butter for some protein. Those of you that are here, excuse me, I'm eating an English muffin. Those of you, we're going to do Lifo, Fifo, perpetual, and weighted average. So go ahead into course content information. And in course content information for the chapter 8 inventory, the same problem that we worked on Thursday of last week when we did the parties or us net and gross. That was problem 1. At the bottom of that sheet is problem 2, which is the Lifo Fifo that we'll be doing today. So bring up that worksheet, split the screen, and pull up the template that I have. So I uploaded a template. All right, so go ahead and have those up. So those of you that are coming in, go into course content information in Blackboard, and the problem that we worked, that chapter 8 in-class problem, go to the second problem. The first one was what we worked last week for net and gross, learning how to calculate net and gross. Go ahead and pull that problem up, and we're going to work problem number 2, which is inventory information for chicory coffee from Louisiana's finest. People especially in New Orleans, love drinking chicory coffee. So bringing in my Louisiana culture here. So make sure that you have that problem and that you have the template. So bring up the problem, split your screen with the template, and then I am going to be sharing screen a lot today. Before.
Which problem exactly is it?
It's under chapter 8 in class. Do you see?
Yeah, but there's 4 files.
Right, so just bring up the one that's the problem, and then bring up the one that's the template. Don't bring up the net gross solution or the notes that I have up there from net and gross.
Okay.
Okay. Has everybody got those up? Now, I am going to first bring up just a Word document so that we can understand some concepts before we get into DVL, before we get into life, well, all of it. This is just concepts about LIFO and FIFO, okay? So FIFO, we know means what?
First in, first out.
Good, first in is first out, which means that cost of goods sold comes from the later purchases. No. Earlier purchases. Sorry, we've just been talking about DVL. So cost of goods sold comes from my earlier purchases. The first ones in are the first ones out. And ending inventory comes from the later purchases, okay? So under LIFO, it's going to be the opposite. LIFO obviously is last in, first out. So cost of goods sold comes from the later purchases because the last ones in are the first ones out. And the ending inventory comes from my earlier purchases. So let's talk about the impact of choosing LIFO and FIFO on the financial statements. In times of inflation, which method will have my most current cost on the balance sheet? So which method is going to have my current cost, which in times of inflation is going to be my higher cost on the balance sheet?
Lifo.
FIFO. So that means that, so in times of inflation, rising cost, FIFO ending inventory will be the later purchases, which is higher cost. And FIFO cost of goods sold will be the earlier purchases, meaning at lower cost. Okay. LIFO will be the opposite. LIFO ending inventory is going to be my earlier purchases, which are going to be lower cost. And cost of goods sold is from my later purchases, meaning higher cost. So usually we're in times of inflation, and which method will have a lower gross profit in times of inflation? Which method would have a lower gross profit? Pardon me?
Lifo.
Good, LIFO. So why would companies want to choose LIFO?
So that they would be taxed less.
Good. It's for tax purposes. There is a law, it's not an accounting thing, it's a law, that whatever method you choose for financial statement reporting, you must also use for your tax reporting. Because companies would choose FIFO for their financial statements because they want their gross profit to be higher. They want their operating income to be higher. So they would choose FIFO for financial statement reporting purposes, but then choose LIFO for tax purposes. Congress said, whichever method you choose for financial statements, you must choose for your tax purposes. Now, You can also look at LIFO instead of it just being, that is the primary motivation is to save taxes. But you can also look at what effect it has on the balance sheet and the income statement, on your financial statements. Do you want your most recent prices, in other words, replacement cost? Do you want your inventory to reflect your current cost? Or do you want your cost of goods sold to reflect your current cost? And that is a decision that the management has to make. Yes, they want to choose LIFO to reduce taxes, but they also have to consider the impact on the financial statements. In FIFO, your current costs are going to be in inventory and your lower cost in cost of goods sold. So it just depends on whether you believe a balance sheet approach or an income statement approach with regards to your inventory. But let's face it, the primary reason that companies choose LIFO is to reduce taxes. And there is enough information that companies are required to put in their disclosure notes where a reader of the financial statements can convert a company that uses LIFO, they can convert the balance sheet and the income statement to FIFO very easily when they're doing their financial statement analysis. So because of that, you know, companies know that if they choose LIFO, yes, their gross profit will be lower. Yes, their operating income will be lower, but they know that the users of the financial statements can calculate what gross profit would be if the company used FIFO and what cost of goods sold would be if they used FIFO. That helps with financial statement analysis, particularly if you're comparing two companies. Say I'm comparing Coca-Cola to Pepsi-Cola. I don't know which each one of them uses, but suppose one uses LIFO and one uses FIFO, and you're doing a financial statement analysis and comparing the two companies. Well, you need to compare the two companies with comparing apples to apples. So they would have to take whatever company uses LIFO, they would have to convert their balance sheet and income statement to FIFO to then be able to compare the two companies, to compare their gross profit percent, to compare their gross profit, their operating percent, their net income percent, okay, what their margins are, okay? So that is your basic concepts. And we need to understand this because we're going to be not only doing LIFO, FIFO per purchase, and we're going to do that in a minute, but we're going to see dollar value LIFO. And then in chapter 9, we're going to learn a lot of what we call RIM methods, R-I-M, retail inventory methods in chapter 9. So we need to keep this concept we need to understand this concept, okay? So I'm going to now let's go to the problem, and I am going to pull up the template. Here we go. And so I am going to share screen with you again. And this time I am pulling up the template. So on the template, I went ahead and prepared the goods available for sale schedule. And we had purchased, we had beginning inventory of 300 units at $10 a share. Then on June 11th, we purchased 800 at $12 a share. And then on June 20th, we purchased 500 units at $13 per share. So that gave me available for sale 1,600 units at a total cost of $19,100. So this $19,100 is going to be divided between ending inventory, the inventory that I still have on hand, and cost of goods sold, the inventory that is gone. So now let's look at what would ending inventory, cost of goods sold, and gross profit be under FIFO perpetual. Okay. Now my beginning inventory I don't know if I had this down at the bottom. You can copy and paste or create it on your worksheet. Did I have this headings?
Yes.
Oh, okay, good. So we had beginning inventory of 300 units at $10 a share, which is a total cost of $3,000. And on June 10th, I sold 200 units, and my revenue, let's go ahead and calculate revenue because we know that we've got to calculate cost of, gross profit. So my revenue is the number of units times, what did I sell these 200 units at? What was my selling price?
$24.
Times 24. Now I'm hard coding here. Shouldn't be. I should have an information box, so just forgive me. So my revenue was $4,800. Now, what was the cost of goods sold? So we would know that we would debit accounts receivable and credit sales revenue for $4,800. Now, what would I debit cost of goods sold and credit inventory for? Well, right now, the only inventory that I have on hand is the 300 units in beginning inventory. So I could have only sold, now this is cost flow, not physical flow. Companies' physical flow is FIFO. Cost flow is different than physical flow. We know that companies, the first ones in are the first ones that are physically going off the shelf. What we're talking about here is the cost flow. Well, the only inventory I had was the 300 units at $10 a share. So my cost of goods sold was $2,000. So I want to keep track of what my cost of goods sold is, because I know that once I subtract cost of goods sold from the 19,100, my goods available for sale, I'll end up with ending inventory.
I got a quick question.
Sure.
How'd you get the negative 200 for the June 10th sale?
I multiplied the 200 times the $10. I put equal, but since this isn't, so I just put equal this times equal that. But you can see the formula.
He's saying like literally where did you get it?
Oh, okay. Got it. You're hard coding like the 200 part. Okay.
No, I didn't.
You did? Well, where's the 200 from?
This right here.
Yeah, so did they give you that as the June 10th sale?
Yeah, look on the instructions. So I sold 200 on June 10th. I sold 200 units at 24.
Oh, okay. So that's why, right. And it's going to be negative because you're selling it.
Right.
Okay. Got it.
So the total number of units that my ending inventory is 100 units. Who's ever got that noise? Can they mute, please? So I've got 100 units in ending inventory that all comes from beginning inventory. Then on June 11th, the problem gave me the information that I purchased 800 units at a cost of $12 a unit. Okay. So June 15th, the problem gives me the information that I sold 500 units. And so my inventory is, my revenue is my 500 units times, what did I sell the 500 units at? What was my selling price?
$25.
25?
Yeah.
So my revenue is 12,500. Okay. Now, the 500, we're doing FIFO. So the 500 would come from my first purchases. Now I've got, at the time, let me delete that. At the time that I sold the 500 units on June 15th, I had 900 units in ending inventory. Where did they come from? The 900 units were made up of what purchases?
100 from beginning and then the purchase.
Oh, was that me? 100 from beginning inventory, good, at $10, and 800 from $12. Okay. So my June 15th sale of 500 units, I'm going to have to insert a couple of rows here because it's coming from two different purchases. Now, one of the terms that I want you to get used to is that every time a company purchases, we call that a layer. As you read in chapter 8 in DVL, we referred to layers quite a bit. A layer is a purchase. Okay. So on June 15th, when I sold the 500 units, first in, first out, I still had 100 units at $10 a unit that I sold. Okay. Let me get rid of that, and I'm just going to go. All right. I sold the 500 at 25. Okay. So I sold 100 of the 500. I removed the 500 because I am going to have to break up the 500 into, it came from two different layers. Okay. So my June 15th sale was 100 units. All right, I'm good now. 100 units that came from beginning inventory. So 100 of the 500 units came from beginning inventory because that's what I had left, first in, first out. Then I had 400 units that came from my June 11th sale of $12 per unit. So my June 15th sale from the June 11th purchases. Oh my. Should be this one. From June 11th purchases. Okay. All right, so we sold 500 units. We had revenue of 12,500, the 500 times the 25. And the cost of those units under FIFO was, I still had 100 units from my beginning inventory, so 100 at 10. And then the remaining 400 came from my June 11th purchase. So after this sale, how many units did I have in ending inventory?
400.
400. And what purchase did they come from? What layer?
2, 1.
The beginning inventory and the June 11th purchase. Or
Okay.
no, they all came from the June 11th purchase. Sorry, the
Good.
ending.
Good. They all came from the June 11th purchase because I had 300 units in beginning inventory. On June 10th, I sold 200 of them. And on June 15th, I sold the remaining 100. So all of the beginning inventory is sold. And then I sold 400 of the June 11th purchase of 800. So the 400 that I have in ending inventory all came from the June 11th purchase. Now on June 20th, I purchased 500 units at $13 per unit. So now I've got 900 units, 400 units from the June 11th purchase and 500 units from the June 20th purchase. On June 27th, I sold 300 units, which gives me revenue of the 300 times, how much did I sell the 300 units for?
$27.
Right, $27. So I have revenue of 8,100. And since that was the last sale in June, I now know that my total revenue in June is 25,400. Now let's take a look at the June 27th, the 300 that I sold. First in, first out. So what would the 300 have come from? Which purchase or purchases?
The
Good.
June 11th.
June 11th, good. Because how many units of the June 11th did I still have?
400.
400, exactly. So the 300 would come from my June 11th purchase, which is at $12 per share. Oh, I'm sorry, I didn't put my cost of goods solds here. So the 300 all came from my June 11th purchase. I had 800. I sold 400. So all the 300 came from the 400 that was remaining of the June 11th purchase. So my cost of goods sold under FIFO is 11,400. If I subtract, I sold 1,000 units at 11,400. So my ending inventory would be the goods available for sale minus my ending inventory. Yeah, so Maya wants to know how we got the cost of goods sold. The cost of goods sold, I just summed up. When I calculated cost of goods sold at the time of each purchase, we sold 200 units on June 10th at $10, which gives me a cost of goods sold of 2,000. So what I wanted to do was I wanted to just take this number, convert it to a positive so that I could just calculate and sum up my cost of goods sold. So notice that every time I sold, I included it in my cost of goods sold column. Maya, does that make sense? Maya? You're welcome. Okay, so if I had,
Just a quick question.
sure.
When they report these numbers for cost of goods sold, like, is there a disclosure note that says the cost is from these purchases, or is that?
Oh no, we don't, that detailed information is not disclosed at all. What,
Okay.
what would be disclosed is what method of inventory they're using. Of course, if they say they're using FIFO, then informed readers of the financial statements understand what that means.
Yeah.
The disclosure requirements for Lifo, however, are more extensive. When you use Lifo, and this is going to be an important concept to understand under DVL, when you use Lifo, you must disclose what the difference is between Lifo and FIFO. In other words, you must disclose if you had used FIFO, your ending inventory would have been X. Okay, so under Lifo, you do have to disclose what your ending inventory would have been under FIFO.
Okay.
And we'll see how we use that when we get to dollar value Lifo and we start using that Lifo reserve account. Now, I know because of the mathematical association that goods available minus cost of goods sold equals ending inventory, I get 7,700. But let's see if we can prove that number. My ending inventory was 600 units. And that 600 units made up of what layers, which purchases?
June 11th and June 20th.
June 11th and June 20th. And how many units from June 11th were still available for sale?
100.
100. And that was at a cost of $12. And we got that 100 because we know we sold everything from beginning inventory. I had 800 that I purchased on June 11th. I sold 400 from June 11th, and then I sold 300 on June 27th, which left me with the 100. And then this last purchased on June 20th, I didn't sell any of. So I've got the 500 units at $13 a share. And when we sum those, we get the 7,700. Okay, which equals. So now let's calculate our gross profit. We know that gross profit is revenue minus cost of goods sold. And so my gross profit under FIFO is $14,000. So gross profit under FIFO is $14,000. Okay. So now let's do Lifo. Now, just to make things a little easier, I am going to I'm just going to copy this down so that we don't have to keep going back and forth. My goods available for sale. So we had beginning inventory of 300 units at $10 a share. And then on June 10th, I sold 200. Well, the only units that I had were at the $10 per share. So I know that my cost of goods was $2,000, just like it was in FIFO, because that was the only layer that I had. Okay. Now on June 11th, I purchased 800 units at $12 per share. At 9,600. And I sold, how many units did I sell on the 15th? How many units did we sell on the 15th?
500.
Good. So on June 15th, I sold 500 units, but what layer are they going to come from? It's LIFO, last in, first out.
It's all from the June 11th purchase.
Good. It's all from the June 11th purchase, because that was the last layer in. So the whole 500 is from my June 11th sale. I'm going to go ahead and delete these because I want to talk about this 400. So we sold 500 from the last purchase. The last purchase was 800. So the 500 of the 800 was sold at 12,000. Of course, my revenue is all going to be the same. My revenue amount, whether it's LIFO, FIFO, or weighted average. So after the June 15th sale, I have 400 units in ending inventory. What did they make up? The 400 came from which purchase or purchases?
June 11th and beginning inventory.
Good. So how many from beginning inventory, Edris?
100.
100, and then the remaining 300 from the June 11th. Okay, good. So then on June 20th, I purchased 500 units at $13 a share. And on June 27th, I sold 300 units. And where are they going to come from?
The June 20th purchase.
Good. Everything from the last purchase, because it's last in, first out. So everything would come from the last purchase of June 20th. Which is at $13 a share, a unit. I'm sorry, thinking about stock today. So my cost of goods sold is $11,900, summing up each one of the sales that we did at its price. So my cost of goods sold is $11,900. And because I had used cell referencing, I didn't have to do all the calculations again. My ending inventory is 7,200. So let me pause and see how y'all are doing on are y'all doing this in Excel or writing it down or?
Yeah, I'm doing it on Excel. I have to say it's easier doing it on Excel than it was on the homework because the chart that they gave was kind of confusing and hard to follow.
Yeah, and I agree with you because they have you doing it where I understand that chart is more confusing. So I just find this way easier. And you know, one thing about the online exam is you can use Excel. You know, if you've got time to do it. All right, so we've got 11,900 as cost of goods sold. We've got 7,200 as our ending inventory, and our gross profit is 13,500. Now, we were in times of inflation, obviously, by looking at our pricing going from 10 to 12 to 13. So given that we are in times of inflation, do you expect your Lifo ending inventory to be lower or higher than FIFO?
Lower.
Lower. Then cost of goods sold is going to be higher or lower than FIFO?
Higher.
Higher. And we see that cost of goods sold is 11,900 under Lifo and 11,400 under FIFO. I think somebody had a question. Do you just go ahead and ask? Since I'm screen sharing, I can get into my chat. So does anybody have a question?
I guess, will you be uploading this Excel sheet?
Yes.
Okay.
Yes, I will. Now let's do, the problem didn't ask you to do a weighted average, but let's go ahead and calculate, because you are expected to know this. Let's go ahead and calculate the weighted average. So I'm going to copy my goods available for sale schedule. And WA is weighted average. Now remember, on weighted average, we're just using the periodic. Under perpetual, you have to calculate a moving weighted average. On Excel, it's not difficult to do, but usually exams are in class, and in class, calculating a moving average, you know, while you're timed and stressed gets complicated on the calculator. So for weighted average, you just learn periodic. not perpetual, which requires you calculating a moving average. So I've gotten my goods available for sale, and that I purchased 1,600 units at a total cost of $19,500. So my weighted average cost per unit is equal to the total cost divided by the number of units. So that is my weighted average cost per unit. I sold 1,000 units. Okay, I sold 1,000 units. So my cost of goods sold is going to equal the 1,000 units times the weighted average cost per unit. So cost of goods sold is $11,937.50. Thus, my ending inventory will be, I can take the goods available for sale minus cost of goods sold and get $71,622.50. Another way that I could calculate it is how many units did we have in ending inventory? So how many units were in ending inventory? If I had 1,600 available and I sold 1,000, we have 600 units in ending inventory. Well, I'll put the ending inventory over here. If I take the ending inventory and multiply it by the weighted average number, then I get the same number.
What's the formula for the weighted average cost per unit?
It is the total cost divided by the number of units.
Okay.
I have a question. During the homework, it had us do the cost per unit per layer. Is that not how you would do it for this?
Not on your, this is weighted average periodic.
But if it was perpetual, would you do it per layer?
Yeah, did you have to do weighted average perpetual on homework?
Yes.
Yeah.
Sorry about that. I thought I had excluded those. So then you know how to do a moving average. I'm only asking that you do it periodic, okay. Not perpetual. Because as you saw, that calculating that moving average just takes time. And when we do an exam in class, I don't want you spending time calculating a moving average. I'd rather you focus on the concept. So as long as you understand the concept of calculating your weighted average, whether you're doing it at the end of the year only or doing it perpetually, it's just calculating the weighted average of the units that you have at that time. Okay, but this is the only thing that I'm going to ask that you do is weighted average periodic, but Lifo and Fifo will be perpetual. Okay, calculating it at every time. Okay, so that is your Lifo, Fifo, weighted average, Lifo, Fifo, perpetual, weighted average, periodic. Any questions?
Can you go over how you got ending inventory?
Ending inventory for which method?
The first one.
FIFO?
No, the weighted average. Sorry.
Oh, weighted average. Okay. One is, remember, if I take the total cost available for sale and I subtract cost of goods sold, you get ending inventory, just like we did for LIFO and FIFO, goods available minus cost of goods sold equals ending inventory. So under weighted average, goods available minus cost of goods sold gives me ending inventory. But the other way that I calculated it, just to kind of prove the number, was we had 600 units. So that's one way. Another way is we had 600 units in ending inventory. So if I took the 600 units and multiplied the 600 units times my weighted average cost, I came up with the same number.
Got it. Thank you.
You're quite welcome. So let me get this saved as dollar value, inventory, template solution. Okay. So now let's move on to dollar value LIFO. And one of the things that I want you to look at is, let's look at LIFO. In LIFO, our 600 units that we had available, so this 7,200, made up, we can calculate it like we did up here for FIFO. The 600 units, let's go back to LIFO. The 600 units that we had in ending inventory, let's go back and look, came from which layers? Now, layers, remember, are purchases. So I want you to get used to the term layers. So the 600 units came from which layers?
Beginning and June 11th.
So how many of beginning did I have? How many units?
300.
100 from the beginning.
Yeah, right. How many did I have left? I had 100 units from, well, here, let me do beginning inventory. I had 100 units because we had 300, and then this sale was from beginning inventory. So I had 300, I sold 200, but I never sold any more from beginning inventory. So that is why I had 100 units left. And then the June 11th purchase, I had 800. I sold 500, and then I sold 300 from the June 11th. No, I didn't. It was from the June 20th, sorry. So on the June 11th, we had 800 that we purchased, and we sold 500. So how many do I have left from the June 11th purchase?
300.
300. And this would have been at a cost of, this 100 would have been at a cost of, oh my gosh, I want to do, of $10. So that would be $1,000. The 300, my June 11th purchase was $12. And how many did I have left from the June 20th? On June 20th, we purchased 500, and then we sold 300. So how many did I have from the June 20th purchase?
200.
200 at a cost of 13. And I sum those and get the 7,200 in my ending inventory, which we had calculated here. So now I see that my ending inventory under Lifo was made up of 3 layers, including beginning inventory. When we look under Fifo, I didn't have any beginning inventory left in ending inventory. And I had more units from my later purchases than I did. See, I had 500 units left of the June 20th purchase in Fifo, but I only had 200 under Lifo. Now, the reason for showing you this breakdown is in Lifo, companies will have in ending inventory older layers. Remember, in times of inflation, Lifo's ending inventory is going to be lower under Lifo. And the reason it is, obviously, is because it has older prices in the ending inventory. Well, this can go on for years. I audited a company that used Lifo, and they had in their ending inventory layers that were 20 years old, 15 years old, because they never liquidated their older prices. They never liquidated their older prices. So go to page 422 and 423. Okay. I'm going to quit sharing the screen right now. Okay. And question?
Never mind, I got it.
Are you sure?
Thank you.
All right. So let's talk about Lifo. Remember, the primary reason that companies have chosen Lifo is for tax savings. And on page 422, you read about Lifo liquidation. And Lifo liquidation happens when they sell more this year than they purchased. Because if they sell more than they purchased, then they're going to start liquidating older beginning inventory. You know, now beginning inventory, remember, is also made up of several layers. You know, we see in Lifo, in the problem that we just did, that beginning inventory is $7,200, but it's made up of 3 layers. So in ending inventory, companies can have very old prices. And I've seen 20-year-old prices, 30-year-old prices, because they never liquidate those older prices. They are selling and they're cost flowing from the later purchases that they had, which is what they want, because the later purchases are the higher cost, and they want the higher cost going into ending inventory because they want taxable income to be lower. So companies don't want to liquidate their layers, because once they start liquidating layers, then they're bringing in older prices into cost of goods sold compared to their revenue is at current selling price. And boy, does that make the CFO of a company's head just turn like, what was that movie? Exorcist, whatever her name was. Oh, well, I forget. Have y'all ever seen that movie?
Yeah.
Old movie, but it's fun to watch. So in Exorcist, where her head does a complete spin, because They absolutely do not want to bring older prices into cost of goods sold, because once they start liquidating those older layers, then they're going to have the opposite effect, because then their gross profit is going to be higher because they're than FIFO, because they're bringing in years old prices. Okay. So Lifo liquidation is something that companies are managing their inventory to avoid Lifo liquidation of older prices. Okay? And that is what you're reading about with the Lifo liquidation. In dollar value Lifo, you're going to see how we use layers. One of the problems with Lifo, we just did 1 month that only had very few transactions. Imagine a multi-billion-dollar company using Lifo and trying to keep the records of all these layers that are in ending inventory at very old prices. Whatever year they adopted Lifo, it could have been 1980 that they adopted Lifo, and they could have 1980 pricing in their ending inventory because they never liquidated those layers. They kept selling out of their current purchases, or maybe purchases from last year, but certainly not starting to liquidate going to years back. Okay. Well, the record keeping is horrendous, whereas FIFO, it's not. FIFO, your ending inventory is going to be made up of a few layers that are at current price, or relatively current price, or price that is, you know, certainly not a year old, because companies are turning their inventory over quicker than that. So you don't have the problem of record keeping with FIFO like you do with Lifo, with having all of these different layers from older, way older prices. So dollar value Lifo came about because of this problem. And instead of looking at a purchase at each layer, they will actually look at the change in inventory from one year to another using price indexing. Okay. So in course content information, go in and pull up, do you see where I have the DVL problem? The solution is uploaded, but just bring up the problem and the template. And you don't really need to split screen this one, because in the template, I have the information that you need in the template from the problem itself. Okay, so I'm going to go ahead and pull up the template.
Joseph's going to have to add it to the cart.
And
That's been a shout for myself.
let me pull up the template.
I have to log into my Prime. It should be on the computer.
Who's ever talking's not muted. Okay. So now I'm going to share screen, and we've got the template. So this is right here is the information that was in the problem itself. And the company adopted dollar value Lifo. In other words, they wanted to use Lifo, and they adopted Lifo in 2014. The price index for the year that you adopt Lifo is always 1. That will be that's like your beginning inventory. That is the oldest price that will stay in ending inventory. Okay.
So that's your ending inventory for that year if you did LIFO that year?
Correct. So what companies do is they go and they count their inventory, and then they price it at end of the year price. Now, if you have ending inventory at end of the year price, then that is FIFO, just by definition. That ending inventory at end of the year price is FIFO. The year that a company adopts DVL, dollar value LIFO, is called its base year. Okay. And that's the reason that the price index is 1. Now in 2015, the company counted their inventory and then they priced it out at end of the year price. In other words, FIFO. Well, I don't know if the increase from 105,000 in 2014 to 134,300 in 2015, I don't know whether that increase is due to a price increase, a quantity increase, or a combination of both, which more likely is a combination of both. Well, I need to know, was there a quantity increase or a quantity decrease? So I need to remove the price effect. I need to remove the price effect. In other words, I need to know what is ending inventory at my base year price, removing the price change, so then I can determine, did I add quantity or did I liquidate quantity? And the way that we remove the price effect is deflate, divide. So I am going to take ending inventory at end of the year price and divide it by the price index. Now, obviously, as David said, for the first year, my ending inventory at my base year price will be the same. So in 2014, well, I misspelled it again. In 2014, my inventory at DVL is 105. So 2014, my inventory at dollar value LIFO would be 105,000. Now in 2014, I need to find out what is my ending inventory at base year price. So I'm going to go ahead and copy, because I had the formula of B divided by C. I just copied it down for all the years, and I now know the ending inventory at base year price for all 5 of the years. So I know I can look at the change from one year to the next to determine if I had added a layer. Remember, a layer is a purchase layer at a cost. And in dollar value LIFO, our cost is determined by a price index. I know the textbook tells you how to calculate a price index. I will just give you the price index. This problem is a former exam problem. So now I need to know, did I add a layer or did I liquidate a layer? So I want to compare this year's ending inventory at base year price to last year's ending inventory at base year price. And in 2015, we added a layer based on quantity of 24,134.62. Now, when I'm working this problem, I would go ahead and calculate, did I add a layer or did I subtract a layer for all of the years? Okay. So I see that in 2016, I liquidated a layer. My ending inventory at base year price is 112, and at 2016, and at the end of 2015, it was 129. So I actually liquidated quantity in 2016. And then in 2017, we added a layer. And then in 2017, in 2018, we liquidated a layer, $17.20. Remember, I just make these numbers up. So we liquidated a layer. So now let's see, now that I know whether I added a layer based on quantity or did I liquidate a layer based on quantity. Now still use the concepts of Lifo here, and let's determine what we would report on the balance sheet as our ending inventory at dollar value Lifo. So now let's do 2015. And in 2015, I added a layer. So that means that I still had the layer from 2014 at a price index of 1. And I added a layer of 24,134.62 at a price index of 104. Okay, remember, we're using price indexes instead of unit price to calculate ending inventory. This is a substitute for my per unit cost. So now I need to reinflate because I want to know I added a layer at 2015 prices to the layer that I already had. So now we're going to multiply to reinflate, just like I did. Well, this actually should be equal to the 105 times the 1. So if I take the 105 times the price index, we know that we're going to end up with the base year being the same because of the price index of 1. And the layer that I added in 2015 at its price gives me a Lifo price, a DVL price of 25,100. When I sum, notice that when I sum my ending inventory at base year price, I ended up with the same number as ending inventory base year price here. All I did was break it into the different purchasing layers that we have. So let me add headings here. And this is okay. So ending inventory at base year price times the price index gives you your dollar value Lifo. Okay.
Oh, I have a quick question.
For my 2015, what would be reported on the balance sheet is 130,100. Edris?
The 25,100. I understand how you got it.
Yeah.
I'm a little confused as to like, So after you get the 24, which is the difference between year 14 and 15, right?
Mhm.
Then you multiply by the price index.
Correct.
Okay.
The reason is this 24,000 represents the increase in inventory that I had at quantity, but at base year price. Because remember, this difference was based on the change in base year price. So this is the quantity that I added in 2015, but at base year price.
So the difference between 24,000 and 25,000 is that difference is just inflation.
Right, right. It is now, this was the layer that I added at quantity. Now I want to know what is that quantity at the
This year's
price
price.
that I purchased it at. Remember, instead of a per unit, we're dealing with price index. So now I have inflated that. So the 25,100 represents the quantity that I added at the current year price.
That makes sense.
Okay, good. All right, so now let's go to figuring out how we handle this from a journal entry standpoint. Companies are maintaining their inventory in their general ledger. Their inventory is going to be at FIFO. Very easy to do at FIFO because they're adding when they purchase, they debit inventory, they credit accounts payable. Then when they sell something, they do it at FIFO because they know what their current prices are. So their inventory account is at FIFO. Now remember, we're reporting on our balance sheet at Lifo or dollar value Lifo. So if my inventory account at 2015 has 134,300 in it, but 130,100 should be reported on the balance sheet, I do that, I'm able to do that through a Lifo reserve account. And you read about the Lifo reserve account on page 422. The Lifo reserve account represents the difference between FIFO and Lifo. Okay, so my inventory at FIFO or in the year price minus my DVL is the difference between FIFO and Lifo. I don't have that. I don't have a difference in my base year. So now let's look at 2015. My ending inventory at FIFO is 134,300, but my ending inventory at DVL is 130,100. So my Lifo reserve account needs to be 4,200. Now, should that be a debit or a credit?
Credit.
Good, a credit, because go back to the concept. Ending inventory under Lifo in times of inflation is lower than FIFO. So your Lifo reserve account is a contra asset to the inventory account. So I want the ending balance of my Lifo reserve account to be 4,200. Now, what is the balance of my Lifo reserve account right now? Have I done any journal entries in my Lifo reserve account?
No.
No, so it's 0. So I'm going to debit cost of goods sold and credit my Lifo reserve account for 4,200.
So this is how you account for the added cost of goods sold when you're doing this adjustment?
You got it. So as David, very quickly noticed and pointed out that, remember, cost of goods sold is higher under Lifo than it is FIFO. And I just made cost of goods sold higher through my Lifo reserve adjustment. Okay.
Really quickly, where did that 4,200 come from? I'm trying to like.
The difference between, look at my formula, the difference between my
Okay.
inventory at FIFO and my inventory at Lifo.
Okay. Thank you.
So it's the 134.3 minus the 130,100. You're welcome. All right, so now let's do 2016. In 2016, we had a liquidation. We liquidated a layer. So in 2015, we had 2 layers, a 105 layer, and at base year price, we had 2 layers, the 105 layer and the 24 layer at base year price. So if I liquidated a layer and I'm using Lifo, which layer did I liquidate 16,798.17 of? The 105 layer or the 24 layer?
The 105 layer.
Okay, last in, first out. Which one was the last in?
Never mind. Yeah, the 24,000.
The 24, good. So the last one in, just like we did on Lifo Perpetual, remember that June 27th sale came from the June 20th purchase. So the last layer in is the one that is going to be liquidated. So in 2016, I still have my 105 layer, but my 24 layer, is going to be reduced by the amount that I liquidated. And that was a negative number, so I have to add. So the layer that I added in 2015, I liquidated some of it in 2016. In other words, in 2016, I sold more than I purchased. So I sold some of my purchases from 2015 in 2016. How's everybody doing?
I didn't understand that. Like, I understand where you're saying that if it's Lifo and you sold more than the last year, then you have to liquidate that beginning inventory. Like, I get that concept because you don't have enough inventory from that purchase.
Right.
But like the numbers, I got a little lost in.
Okay. So I had a 24,134 was the last layer that was added in my inventory. Okay. Here we calculated that we liquidated a layer of 16,798.17. So that means that 16,000 of the 24 is gone. I sold it. So if I take the 24 minus the 16 that I liquidated, I end up with 7,336.45 of this layer left in 2016. So the layer that I added in 2015 only has 7,336.45 left because I sold part of it.
Okay.
Okay. And that layer is at the 104 index. Well, Lisa, what is your problem? Okay. And I'm going to then do the same thing, multiply to now get what is ending inventory at DVL. At DVL, now including not only the quantity, but the price change. So I reinflate at my index, and now my 2015 layer that I still have in 2016, quantity at 2015 price is 7629. So we're going to add these. And notice that my 112,336.45 agrees with this total number. And the amount that I would report on my 2016 balance sheet would be the 112,629.91. Okay. Why don't I have in 2016, my price index is 107, yet in 2016, I don't see a price index of 107 in my ending inventory. Why?
Because the actual cost to you of buying those goods was at that value at that time. So the fact that like now the change is 1.07, it doesn't change the price you paid 2 years ago.
That's true. Another way to, a way to look at it is from a Lifo standpoint, all of the inventory that, do I still have on hand any inventory that I purchased in 2016?
Oh, no. So anything you bought at 1.07, you got rid of this year.
Exactly. That's a much better explanation. All of the inventory that I bought at a 107 index, I sold it. I sold everything that I bought in 2016, plus some from 2015. So in 2016, I sold everything I bought, plus I sold 16, 798, 17 from 2015.
So just to clarify, when you have a negative layer, that's because you sold more, like you said, you sold more than you purchased in that year, which means you had to go to the previous layer, correct?
You got it.
Okay.
Okay. So when you liquidate, you will not see an ending inventory, that price index. When you liquidate, you will not see the price index from that year because you sold everything from that year, plus some from the previous year. So in 2016, I would report on the balance sheet 112,629.91. So let's see what adjusting journal entry we would need to do to reflect reporting DVL on our balance sheet. Remember, my general ledger is going to have 120,200 in the general ledger. 2016 quantity times 2016 prices, whatever they bought it for. So my ending balance of my Lifo reserve needs to be the difference between FIFO and DVL. So my ending inventory at end of year price, FIFO, minus my DVL.
What is that $120,000 number called again, or where does it come from?
This one,
Yeah.
it's ending inventory. So the quantity that I had at the end of the year times end of the year price times current price, which is
And
my,
where is it reported?
it's in the inventory, it's in the general ledger inventory.
Okay.
So your inventory general ledger account has 120,200.
Okay.
But we want to report 112,629 on the balance sheet. So when I net 120,000, let me show you, equal 120,000, my LIFO reserve has a credit balance. So minus my LIFO reserve equals my DVL. Okay, so I will put ending inventory at end of year prices minus DVL.
Can you real quick explain DVL again? I'm like blanking on it all of a sudden.
DVL is where I calculated what did I have in ending inventory.
Right.
So do you understand where the 105 and the 7336.45 came from?
Yeah.
Okay.
Variables that go into it.
So then when I reinflate, I know that I added quantity in I liquidated all of my 2016 purchases, and I liquidated 16,000. I sold everything I bought in 2016, and then I liquidated 16,798 from what I added in 2015. So that's where I got the 733.45. Okay. So when I reinflate at end of the year price at the 104 index, then I ended up with inventory valued at dollar value LIFO, the amount that should be reported on the balance sheet. See, balance sheet.
Mm-hmm.
Balance sheet is 112,629.91. Okay, so that's what I want to report on my balance sheet. My general ledger, when I look at my adjusted trial balance, my inventory is going to have a debit balance of 120,200. And my LIFO reserve account, which has a credit balance, because it's a contra asset, when I net the two, I end up with what I want to report on the balance sheet, the 112. See how these two numbers agree?
Yes.
Okay. All right. So I want the ending balance of my LIFO reserve account to be 7570.09. What is the unadjusted ending balance in LIFO reserve right now?
4,200.
4,200, good. Because we had credited for 4,200 the prior year. It's a permanent account, so it wasn't closed out. So now my adjustment is going to be, my journal entry is going to be for the difference. So my journal entry is going to be the 7570 minus the 4,200. So in order to get my LIFO reserve from 4,200 to 7570.09, I need to credit the LIFO reserve for $33.70.09. And debit cost of goods sold. So although they liquidated a layer, they still have a credit balance in their LIFO reserve, because FIFO is still higher than DVL. Okay.
Why did it go up even though they liquidated it?
Because they didn't liquidate enough from the, once you start liquidating into your base year, into those real older prices, then it's going to switch on you. And that's why companies will do even dysfunctional buying behavior in order to not liquidate too much.
Okay.
It's a fine balance between managing their quantity of their inventory and not liquidating so much that you start reversing the effects, and DVL ending inventory becomes higher than your FIFO ending inventory. And that can happen if they start liquidating too much into these earlier years.
Yeah.
Okay. All right, so now let's do 2017. In 2017, we added a layer again. Whew, quit liquidating, thank goodness. So we added a layer. So in 2017, I still have the 2 layers that I had in 2016. Sorry, this should be that number. Okay. So I still have the 2 layers that I had in 2016.
Wait, don't we have 7,000 now from 2016?
Oh, sorry. Thank you. I pulled the wrong number. I went up to 2015. Thank you. Sorry. Whew. All right. I'm looking at 2016. I went up to 2015. Let me just close it. So in 2017, we added a layer. So I still have the 2 layers that I had in 2016, the 105 and the 7336, but now I've added a layer in 2017 of 8305.75. I'm going to sum those because I want to make sure that when I sum them, that they equal to my ending inventory at base year price. Okay. Now this 107 was from my 2017 purchases, which is the 109 index. So at 2017, I added a layer at the 2017 index when I reinflate so that I have quantity times 2017 price, and then add all my layers up that I still have, my DVL at 2017 is 121,683.18. So that is what would be reported on the balance sheet. So now let's go up here and figure out what my LIFO reserve, well, that didn't work, should equal. Oh, I know why. My ending inventory, 131,500 at FIFO, minus what I want to report on the balance sheet, means that's what I want my LIFO reserve to be. Notice that when I take the 131,500, subtract the ending balance of my LIFO reserve, I get what's reported on the balance sheet, 121,683.18, which equals what I want to report. So now let's do our adjustment. And somebody tell me what the amount would be. Somebody else calculate it.
$1,423.
What is the unadjusted balance in your LIFO reserve account right now? So we credited it here for 4,200. We credited here for 3370.09. So what is the unadjusted balance of your LIFO reserve account? $7570.09. I want it to be 9816.82. So my adjustment is going to be for the difference between these two numbers. Because my unadjusted would be 7570.09 and I want it to be 9816. So in order to get it there, I will need to credit the LIFO reserve for the 2246.73, increasing cost of goods sold.
Can you explain that number again? Like, see, this is the part that kind of stumps me. I don't know why. So what do you subtract for the debit to COGS?
Okay, let me, all right, I'm going to create a T account.
Will you upload this Excel file as well?
Yes, but it won't have, I'll upload it as a PDF.
Okay, that's
Yeah, the reason is because then you could, well, you know, the obvious reasons why. So the LIFO reserve account, I credited, say this is a T account, all right? So I credited it in 2015 for 4,200. What is, I'm getting, and then in 2016, I credited it for 3370.09. So my unadjusted balance is 7570.09, which is what I wanted it to be at the end of 2016. Now, the end of 2017, I want it to, the adjusted balance to be 9816.82. So what is it going to take to get this number to this number?
just an additional credit.
Right.
The only thing I'm a little confused about is so there's a 9,000 right there and a 7,000, and then if you go up to the layers, there's also a 9 and a 7. So like, or the LIFO reserve. I'm sorry. So for the LIFO reserve, it's the difference between the ending year at that price and then the ending year at base price.
No. it's the difference between, so your LIFO reserve is ending inventory at year-end price
Minus base year.
minus DBL. So my ending inventory at year-end price is 131,500. So put that in your calculator. My DVL is 121,683.18. And what is the difference between those two numbers?
98.
So this is like the step-by-step process is like figuring out that DVL based on the layers, and then figuring out the LIFO reserve.
Right. I need to adjust. The company, like I said, is keeping track of their inventory because it's much easier. They're keeping track of their inventory using FIFO. Then when they go to prepare financial statements, they need to convert from FIFO to DVL.
Yeah.
So this is the process that we're going through right here to convert from FIFO to DVL. Okay.
Yeah. And we just kind of keep track of it year through year based on the amount that's being taken out or put in.
Correct.
Okay.
You know, did they sell more than they bought this year, or did they sell less than what they bought this year?
Yeah.
If they sold more, they liquidated a layer. If they sold less, they added a layer. Okay.
Okay. But just kind of trying to parse it out. It's like there's that part to get this balance sheet number, and then there's the separate part of figuring out the changes in reserve.
Right. You've got to figure out what you want to report on your balance sheet so that you can then adjust your general ledger to reflect DVL method.
Yeah. And every adjustment is just based on previous adjustments.
LIFO reserve. Right. We do that through the LIFO reserve. So my LIFO reserve, I credited for 4,200 in 2015. I credited it for 3,370 in 2016. I calculated that it needs to be an adjusted balance of 9816. So what is the adjustment in 2017?
Yeah.
Okay.
These are like plug numbers, kind of?
Well,
Just kind of. Yeah, I don't mean like, I know there's other ways.
Yeah, there is. I mean, you could.
Or at least the way we're doing it here, right?
Right. Yeah. All right. Well, and the way they do it too, I mean, nobody's going to take the time to go through every sale using, the reason that we use DVL is to avoid doing the minutia that we did in LIFO perpetual. Imagine like if I'd been doing this for 30 years, how many layers I'm going to have.
Yeah.
But doing it by price index, I can keep up with the layers, even if I have 30 layers in my ending inventory, much easier than keeping track of it at each purchase. Here, we're just keeping up with all of the purchases in 1 year by a price index instead of every single purchase during a year, and keeping track of it at every unit price that I purchased it at.
Yeah.
Read in the textbook how the price index is determined, and that will make sense.
Yeah.
Okay. All right. So now let's go to our last year. And in our last year, we liquidated a layer of just $17.20. So I want y'all to do this one. Well, these were cell referencing instead of, so I'm going to.
Professor, last Thursday you mentioned that Blackboard was updating the grades for the test.
Yeah.
It looks like nothing has changed as far as the test grade.
David said the same thing. And when I look at gradebook, it does have the updated numbers because David, yours did change.
Oh, okay.
David, do a private chat to me and tell me what you earned, do you remember what you had on the original exam?
Yeah.
All right, send me that privately in a chat.
Okay.
Because everything else, like as far as the Connect homework and the quizzes and stuff, those have all went in fine. It's
Yeah.
just the test that hasn't updated.
Yeah, and when I look at it, because y'all said that, when I looked at it, it has the updated numbers in the grade book, so I'm confused. David, did you send me a chat?
Yeah.
Okay, let me see where I find it. Since I'm in share. Let me go here. I'm gonna stop sharing. Oh, wait, here it is. Okay, yeah, well, David, yours is, maybe yours didn't change. All right, I will double check it. Address, or who else was asking about theirs didn't change?
Yeah, that was me.
Okay, you, Josh. Josh, send me a private text on what yours was, and I'm going to check these out. And because I don't get it. I don't know really if anybody's that didn't change, at least some. Did you? Come on, chat. Come on up. Where did I get you before? Well, I'm trying to see. Oh, here it is. Okay. All right. All right, Josh, I will, just using yours as an example, we'll go and check it out, and then I'll send out an announcement about it, okay?
Sounds good, thank you.
Thank you for sending me that, and then I'm gonna go check them out, because there were very, very few, if any, maybe that did not change in both classes, so I don't know. Let me go figure it out. Because I've already, remember I told you I had to do a syncing process, and then it was in a calculating for a long time. It did that. So I will check it out, because I don't know why, but I'll figure this out. So thank you for sending me your number, and then I will look at the updated number and see why it's not in there. But I didn't know anybody's older scores, so I couldn't tell whether it had changed or not. So thank you for sending me your older score, if that makes sense. Okay, so I just finished 2018. And let me see if I,
So just a question about this. Are you still gonna, on the exam, like do it in the connect problem form? Because I may be in the minority, but I actually thought that was easier. Maybe just that's what I got used
I
to.
don't care how you calculate it.
Okay.
A lot of students find this easier than the connect method, because once you get in the routine of it,
Right.
whichever way makes sense to you, I don't care.
It will be in that format though, with like the big box, and then you fill out the little parts.
This was a former exam question. So when
But I mean, like on this coming exam, like it'll look like the connect one.
oh shit, yeah, because it's
Right. That's what I'm saying, because I like that way better actually.
okay, yeah, well, yeah, because I can't control
What they give, yeah.
which way you do it, but understanding does this help you understand the concept of the calculations that you were doing?
Yeah, I actually figured it out pretty good on that though, like especially with the hint video. I don't know.
Yeah, but you're not going to have a video on the exam, so
Right, yeah. That's why I'm going to learn both ways.
back into Connect and practice it in Connect and get to the point where you're not using that hint video. Okay.
Yeah.
All right. So in 2018, we liquidated a layer just by $17.20.
I think it got added accidentally. Just I think the signs are wrong because it's in 2018 it's 17 higher.
Oh, yep. Okay. So we still had the first two layers, and then the last layer we liquidated by $17.20. So when I subtract $17.20 from the last layer, I get $82.88 at the 109 index. And then we reinflate, add it, and my balance sheet would report the 121,664.43. When we go to the Lifo reserve, it should be the difference between FIFO or your Lifo reserve, your ending inventory at end of the year price minus your DVL. So I want my Lifo reserve to end with 13,435.57. So my adjusting entry will equal what I want it to be minus the unadjusted balance, which would have been the balance from last year. And so my adjusting entry would be debit cost of goods sold and credit Lifo reserve. When a company liquidates enough, this journal entry can get reversed. If your DVL ends up being higher than your FIFO because you've liquidated older costs, like if I had liquidated all the way, like say I had liquidated in 2018, say I had liquidated all of these layers and part of my beginning inventory, then my journal entry would have to be reversed. I would have to debit Lifo reserve and credit cost of goods sold. And that's why companies just fear that LIFO liquidation, because then your cost of goods sold becomes lower than it would be under FIFO. And that is what they don't want. So companies have to manage inventory really well when they're doing LIFO to make sure that they're not liquidating so much into those older prices to the point where they have to debit LIFO reserve and credit cost of goods sold in order to get what the ending balance of the LIFO reserve should be. Okay, so I will post this on the solution on Blackboard, and I will do it in PDF form because quite honestly, you could just keep my Excel sheet and load it up with whatever exam numbers are, and then.
Yeah, definitely. It's just a reference to practice is all.
Right, so just a reference to practice. I will upload for you more problems, and whatever way you calculate it is fine. Since it's online and you want to calculate it the way that Connect does, that's fine. But the concept is exactly the same obviously is what we're doing here with how many layers did what is the amount did I liquidate or add a layer? Remember, you have to first deflate, then see what the difference is between last year and this year at base year price to determine if there's a liquidation, and then reinflate the layer that was added at the price index that it was added at. Okay? I will upload this on Blackboard. And practicing this, I will upload practice problems. And practicing this on Thursday, we will answer any questions that you have from Chapter 8. And then we're going to get into the RIM methods, retail inventory methods in Chapter 9. We're going to get into lower of cost or net realizable value in Chapter 9. So we'll start Chapter 9 on Thursday. On Thursday, of course, you'll have a start chapter. No, we're not. No start Chapter 9 quiz. No, because the concepts are still about inventory. So no Chapter 9 start quiz on Thursday. We'll just come into class, answer questions that you have in Chapter 8, and then start learning some more methods.
Thank you.
You're quite welcome. And if all of my office hours are filled up for tomorrow, I'm gonna go look now. I'll add more slots. Okay.
Hey, you.
You're
Thank
welcome.
you.
Have a beautiful day.
Practice. I will. Y'all do the same.
Thank you. Have a good day. See you.
Registration. Make sure you're cleared.
Bye, Professor. Have a good day.
Thank you, Paula. You do the
Thanks. See
same.
you.
Bye-bye.